It takes time, commitment, and patience to build a business or a finance department. The right financial people in the right places drive growth and maintain stability. When a key financial person must be sourced or unexpectedly replaced, trust the finance team to step in with part-time financial managers and directors at a fraction of the cost of a full-time resource. We slot right into your organization, adding value and ensuring continuity. The finance team, it's the best way to keep your house in order.
Hi, welcome to our presentation on raising debt finance to survive the COVID-19 storm. My name is Richard Angus. I'm a chartered accountant by profession, spent 13 years of my life in financial services. Last 10 years have been spent in entrepreneurial environments as the CEO of the finance team, where we provide part-time and interim financial managers and CFOs to businesses that need financial executive support. The objectives of today's session is to talk a little bit about the key sources of debt funding for your business under the COVID-19 scenario, to share the key considerations for selecting debt funding and how you go about that, ultimately in terms of a process to secure debt funding. So let's just talk about the structure of our presentation and what we'll be covering. Firstly, we'll be talking about some of our guiding principles. Secondly, we'll be chatting about our availability versus cost of debt question. How much should you be taking on? Then we're going to be talking about COVID-19 specific debt funding mechanisms that are available to you as a business owner. We're then also going to talk about traditional funding products and how these can be utilized. And then finally, we're going to be talking about the actual funding application process. Let's do a quick recap of where we are. We're not talking about businesses that are under urgent liquidity funding crisis scenarios. Those businesses we've already talked about in terms of liquidation or business rescue issues. We're ultimately looking at businesses which are facing challenges. They can bounce back, they're temporary, the challenges are temporary in nature and are as a result of this COVID-19 challenge. Ultimately, it's about survival and being able to bounce back, wait it out and grow. As we know, we've been talking about COVID-19 as a storm at sea. We've covered phase one, the seal the hatches, man the stations, batten down. We're now going to be talking about the responding to the storm, how you survive, how do you make sure as the captain you've stopped the leaks, you've manned the stations, and you actually have a plan to ride out the storm. From a business perspective, you've already talked about cutting costs, how you plan your different scenarios, how you preserve your cash flow. If you look at our journey, okay, we've already talked about mastering your mindset, being a leader in the crisis, assessing liquidity and planning different scenarios, understanding how you reduce costs under those scenarios, how you restructure roles, what is the impact on your supply chain, making sure that your operations match the demand that's in play. We're now at that critical point where we're talking about managing investors in terms of raising funds, the whole debt versus equity question. Let's talk about our guiding principles. The first guiding principle is key to the entire debt raising question, and that is your track record. Any historical relationships that you have with debt providers will make sure that you get preference at this time of need. Second guiding principle, we need to assess your needs versus availability of funding. Just because it's available doesn't mean that you should be taking it, and you've got to understand that ultimately all of this debt funding that you take has to be repaid, and you've got to consider all of the implications of that. The third guiding principle is the whole question of security. Ultimately, debt lenders always need comfort, and they're going to be looking for comfort through assets in this time of crisis. You're very fortunate at this time. Government has stepped up to the plate and has provided guarantees in a number of different cases and scenarios. Unfortunately, lenders will also probably be looking to you as a business owner to provide a level of suretyship that you're standing behind your business at this time. The fourth principle is the whole question of having and knowing your numbers. This is a critical part of any debt raising scenario. This is the place that we play in as the finance team. where we want to know what's going on with your past actuals, your whole question of your compliance, realistic forecasts, and ultimately knowing exactly where you stand as a business. The fifth principle is unfortunately the scenario of what's your skin in the game. Debt funders want to know that you, as the business owner, are putting a commitment behind your business and they're not the only ones coming to the table. Okay, let's talk a little bit about availability and cost of debt and what you should be thinking about. Ultimately, when we talk about debt raising, you've got to consider the entire cost of debt, and you've got to consider all of the fees, all of the terms and conditions, and all of the elements, including repayment structures, that are linked to the debt that is available to you. Remember, you've just gone through an exercise of cutting costs, so you want to make sure that you're getting that debt at an appropriate level of cost, not at any cost. Another thing to consider is just the whole question of where you are in terms of your medium-term liquidity. Now, what do we mean by that? Well, consider our image that you see on our slide. Remember that once you come out of the storm, ultimately, you're not sailing out of the COVID-19 storm into smooth seas. The seas are still going to be rough. There's going to be the icebergs floating around. And you want to make sure that your plans under the COVID scenario don't translate into you exiting the storm and sailing straight into the next iceberg, being a scenario where you're unable to repay the debt that you've raised and unable to afford the interest costs that you've taken on in terms of the borrowings that you've undertaken. Another element in terms of this issue is you've got to consider the ownership profile of your business. Ultimately, if you perhaps have the intention as the business owner of retiring or selling and disposing of your business in the medium to long term, you've got to make sure that the debt structures that you consider now under COVID-19 are matched to those long-term and mid-term expectations that you have as an owner. We're now going to talk a little bit about COVID-19 and the specific debt funding mechanisms that exist. Please remember that there are a number of funding mechanisms out there. We are going to be talking about some of the key ones that we believe are critical for you to understand. There are, in addition to what we are covering here today, some very specific industry support mechanisms that have been created. We're not going to cover all of those in great detail. We're going to be covering the mainstream funding mechanisms that are COVID specific and that you can access. It's important to understand that you are getting debt funding support specific to the COVID environment from two sources, the public sector as well as the private sector. In the public sector, we have two forms of mechanisms that are available to us. There's short-term funding as well as longer-term funding. Let's deal firstly with the short-term funding question. Now, you may not think of this as short-term funding, but this definitely is a form of delayed payment and obligation that you take upon yourself in your business as a creditor. And we're talking here specifically the supporting mechanisms that have been put in place by the South African Revenue Services, or SARS. We're talking about delays in skills development levies, VAT payments, PAYE, as well as provisional tax. All of these payments have been delayed to a greater or lesser extent, and this allows you to keep the cash that you would previously have paid for those obligations inside your business, and you're actually able to use those for other purposes under the COVID-19 stress scenario. The other thing that SARS has indicated that they are willing to do is look at any debt concessions that have previously been made with them, and they are happy to rework those debt concessions. So if you had a debt concession that a payment needed to be made during this time period, SARS is willing to relook at those. There is another element that is critical, and it's the support environment around essential good imports. And this is where SARS has said that they are willing to delay customs duty as well as VAT on essential goods imports. That's obviously to support the flow of goods into the country and to make sure that we're able to get what we need as a country. Critical to remember is that there's no need for you to apply for this. It's available to all compliant and qualifying businesses, and every business should be making use of these mechanisms so that you can make sure that you're getting the maximum benefits. Now, let's look at the longer term public funding mechanisms that we have available to us. Now, I'm going to go through 3 of these. There is going to be a list available for download with all of the detail that we're going to talk about now. So don't worry about making notes. There is a PDF document available to you that will be available for download. The first mechanism that I'd like to cover is the COVID-19 loan scheme that is being guaranteed by government to the value of 200 billion rand. Effectively, that's for companies where they have turnovers below 300 million, non-listed, and they have to be companies that are in good standing. This scheme is being administered by the banks, by the large banks. However, government is guaranteeing these loans. You have to be able to show that the distress that you are currently under is COVID-19 related, and you must be at the limits of your own borrowing capacity in terms of your business's balance sheet. This is a 5-year loan with 6 months payment holiday. It is drawn down over a period of 3 months, and it is at an interest rate of prime. The next funding mechanism that I'd like to cover is the SMME Debt Relief Finance Scheme. That's a 200 million rand funding mechanism. You have to be SIPC registered. You have to be 100% owned by South African citizens. 70% of your employees have to be South African citizens. You have to be SARS registered, tax compliant, and UIF compliant. This loan comes to you at a rate of prime -5, so a very attractive rate, and can be used for things such as stock purchases, bridging finance, purchase order finance, and any capital requirement finance that you have. The final scheme that we'd like to talk about is the Business Growth Resilience Facility. This is a 300 million rand scheme. It's for all existing businesses, but it is geared to take advantage of supply opportunities on the back of COVID-19 requirements or any shortages in the local market for goods such as medical supplies and critical non-food essentials. Now let's look at the private funding mechanisms that are there. You have long-term funding opportunity or funding mechanisms there. The first one that I'd like to talk about is the South African Future Trust, SAFT. That is a R1 billion funding mechanism. It's an independent trust set up by Nikki and Jonathan Oppenheimer. It's for SMEs with a turnover of less than 25 million rand per year. It offers direct financial support to the employees who are at risk of losing their jobs. The company enters into a 5-year interest-free loan agreement with SAFT to repay the amount that has been granted, and banks are being asked to facilitate these loans on behalf of the trust. The second funding mechanism that we'd like to talk about in the private sector is the Sukuma Fund. That is a R1 billion fund once again. This fund is Rupert family funded, administered by business partners. It is an unsecured, interest-bearing loan of anywhere between R250,000 and R1 million. It is interest-free for 12 months with no repayment obligations during that period. It is repayable after 12 months with interest being charged at prime from month 13. It's designed to cover payroll, rentals, and monthly operating overheads. There are no security requirements for this loan. Then the final funding mechanism that we'd like to talk to is the whole question of bank assistance. Various banks are coming to the party and providing various payment holidays and debt restructuring opportunities for you as a business owner. Please talk to your bank, make sure you understand what opportunities they can provide for you, and make sure you're using the correct opportunities from them. Okay, we'd now like to talk about the other traditional funding products that are available to you as a business person. Now, our preferred product options under COVID-19 are 3 traditional funding products that are very strong from an asset-backed lending perspective. And these are as follows. The first one to consider is invoice discounting. This is when you approach your bank and you effectively sell your invoices to the bank, and they then give you a portion of the funding linked to that invoice, and then they collect from your debtor, and this is known as invoice discounting. It has great borrowing capacity, up to often 80% of the value of the invoices that you are discounting. However, it does have increased operational complexity for your business. However, it is a great way of raising funding based on actual business activity. You can show the bank the invoices that you're able to do right now, and they're able to discount those. So that's a great one to use. The next one is to consider a sale and leaseback. You may historically have purchased assets that you purchased cash and are now fully paid, and you want to be able to unlock the cash from your past investment. Effectively, what you would do is you would go to your bank, you'd enter into a sale and leaseback transaction where you sell the asset to them and then lease it back from them. Obviously, you lose control over that asset, and that's one of the downsides of a sale and leaseback, but it is a great way of restoring or allowing you to resurrect cash that you've previously used to purchase assets. The final one that we really like is similar to sale and leaseback, but it's a much longer term, and that's property refinancing. If you've already paid for your property that you occupy as a business and it's been paid for fully, or in fact, even if it's paid for partially, you may be able to utilize the equity that's in that property and actually refinance this with the bank and obtain an upfront cash flow scenario. The one important thing to remember when you do this, though, is whilst it does give you longer term funding, there are some capital gains tax implications, and you need to be quite careful about how those play out in your business. Very advisable to seek professional advice in that regard, particularly from a tax perspective. Then just some additional funding products that one could consider and that we think you should be thinking about. Now, in terms of other loans and overdrafts, there are 3 that I'd like to mention. The first one is the whole concept of crowdfunding. Now, this is a low interest rate environment where you crowdfund for your business. Lots of people would look at me and say, really, at this time? There are a lot of crowdfunding opportunities for smaller businesses, restaurants, for example, where people are buying into the future utilization and effectively crowdfunding the business to help keep the business in a sustainable state, so that when the COVID-19 environment crisis is over, they're actually able to enjoy the restaurant or the smaller business. Obviously, the one thing to consider, many crowdfunding opportunities have debt to equity conversion elements linked to that. So just be careful that you don't end up giving away your business to those that have crowdfunded you in the past. The second form of loans, other loans that you can consider, is the whole question of angel finance. There may be somebody out there, a funder, that is prepared to take higher risk on you as a business and is a big believer in your business, and is prepared to come to the table right now in this COVID-19 crisis to help you through this. Once again, please remember that most angel funders will be looking for some sort of equity conversion at the end of their debt cycle, and so be careful about how much you take from an angel investor and what the equity dilution actually is for you. The third loan type that I'd like to chat a bit about is the whole question of microloans. Now, these might seem really attractive because they're quick access, and you can literally complete a few forms, send it in, and you'll get access to your money within 48 hours. The problem with these types of loans is they're often at very high interest rates, very short repayment periods, and the fees are incredibly high in many cases. So just be careful of that microloan offer that arrives in your inbox, tells you about what they can give you. Just be cautious that you understand all the pros and cons, and especially the costs associated with that. The other thing that you can consider doing right now is going to look for some growth finance. That's flexible debt financing that you can bring onto your balance sheet, and it's really there for high growth businesses. And there it would be really important to make sure that you're able to show the financial institution or the financier that's going to be lending to you how you're going to plan your growth both during and post the COVID scenarios. And there you're looking at making sure that your long-term planning is actually well advanced and your scenarios are extremely positive. Another form of finance that is available out there is trade finance. What you're doing there is it's a transactional funding opportunity. Basically, you fund, for example, the import of particular inventory or a capital item, and effectively you finance a specific transaction. The transaction plays out, and then you effectively take delivery of those goods once you're able to repay the financier. These are traditionally used in import scenarios, and so they tend to be short dated. You're talking 60 to 90 days. But in the current scenario, if you've got suppliers, for example, that are not prepared to work with you anymore on open account basis, for example, as international suppliers due to the COVID-19 risk, you may in fact need to put some trade finance in place with your local bank, where you're actually paying for your items in advance through a trade finance environment. A letter of credit is often what it's referred to, and then receiving the goods and then paying the bank when the goods actually arrive. The other final part of funding that we could consider is actually supply chain finance, where you can actually get your purchase orders funded, often up to 100%, through using being part of a supply chain in a large organization. Many of our large corporates actually provide supply chain finance support. And at this point in time with the COVID scenario, now is the time to look to your supply chain and ask for support both in terms of the short term as well as longer term arrangements. Now let's talk about the funding application process. Remember, we said that there were a number of steps that you need to go through. Well, you need to look at your funding application process as a little bit of a look at the past, the historical, look at the present, and then look to the future. So let's look at the historical scenario. Ultimately, in this scenario, it's all about compliance. You need to make sure that you have your tax clearances up to date. Your tax returns are complete. Your SIPC returns are in. No lender is going to engage with you if there isn't full compliance in place. In terms of your past performance, this is a critical part of what you're going to be doing. You have to be able to prepare a detailed business performance assessment and document, and it needs to have your most recent annual financial statements, either audited or reviewed, depending on what is required, management accounts that are up to date, and then they're going to be looking at many of your financial ratios, such as margins, stock turnover, return on equity. They may be just some examples that we could state, to look at how your business is actually performing. Here you need to be looking to people like your financial managers, people like the finance team, to make sure that you've got the support in place and that the actual information that you're providing your funders is accurate, complete, and that you have a really good handle on those numbers like we talked about in our guiding principles. It is also important, if you were a loss or are a loss-making entity, you've got to be able to explain the turnaround strategy to improve performance, okay, and how you're going to restructure the business. This might be a very good time in terms of COVID-19 to restructure certain elements of your business, but you've got to be able to show how you're going to be moving through that loss-making scenario. In terms of the present, it's really important that when you look at management, you have to be able to show that you've exhausted all of your support scheme opportunities, that you've done everything you can around cost reduction measures inside the business. You have to show as management that you have a very clear knowledge of the fixed costs that you've got within your own business, and that you have commitment as a management team to supporting the survival of this business in the COVID-19 scenario. Cash flows, well, we all know that cash is king. You need to prepare short-term cash flow and financial forecasts. You need to make sure that you understand your revenues and what the sensitivity is of revenues and how that impacts on both your cash flows and your ultimate profitability of your business. Finally, in terms of liquidity, you must know exactly what your liquidity gap is that you're looking to fund. It's no good saying, well, I think I need a number. You need to be able to show exactly how that number arises and what that number is. You need to also be able to clearly show how the funding will be used and what gap it will cover. In terms of the future, remember what we talked about with the iceberg. Remember, ultimately, your medium-term liquidity is key. If you're going to be approaching a funder, you need to be able to show how you're going to make capital repayments as well as interest payments on any debt that you are raising. It is pointless to have a debt raising scenario or debt borrowing scenario if you're unable to make repayments. And your lenders are going to be looking for exactly that. How are they going to get their money back when this is over? You also have to make sure that your emergence plan as you exit the storm, that you're in a strong position, that you know exactly where you are, what the different elements are, how you're going to move around on those rough seas. Remember, they're not going to be calm waters after the storm, and how you're going to avoid those icebergs and make sure that you're not going to run into any of those. And an integrated forecast is key to getting that right. And any lender will feel a lot more comfortable if they've got an integrated forecast from you in terms of the funding that you're trying to raise. We thank you for your time, and we wish you all the best in your COVID-19 endeavors.
It takes time, commitment, and patience to build a business or a finance department. The right financial people in the right places drive growth and maintain stability. When a key financial person must be sourced or unexpectedly replaced, trust the finance team to step in with part-time financial managers and directors at a fraction of the cost of a full-time resource. We slot right into your organization, adding value and ensuring continuity. The finance team, it's the best way to keep your house in order.